September 1929. A businessman in Manhattan felt a disturbance he couldn't explain, a quiet tension hidden beneath the glittering rise of the stock market. For years, prices had soared like a promise of endless prosperity, yet beneath that shining surface, invisible fractures were spreading. On a crisp Tuesday morning, driven by instinct and an unshakable sense of dread, he stepped into his bank, placed his passbook on the counter, and calmly demanded every dollar he had. The teller counted out $12,000 in bills, his entire fortune, stacked into his briefcase. By Thursday, just 48 hours later, the markets collapsed with a violence that would scar generations. Banks across the country fell silent as panicked depositors crowded outside locked doors. But he stood apart from the chaos, protected by the simple fact that he already held his money in his hands. He had escaped the storm before it broke. Now imagine attempting the same thing today. You sense danger looming in 2026 and try to do what he did, pull your wealth out and get to safety before the crowd awakens. You open your 401k dashboard and see $180,000, the product of 20 years of discipline. You click withdraw, but instead of cash, a penalty calculator flashes before you. Federal tax, state tax, and the unforgiving 10% fee for touching your own money before age 59 and a half. Your $180,000 dissolves into $98,000 before you receive a single cent, and the nightmare deepens. The withdrawal doesn't happen instantly. It doesn't even happen today. It enters a processing queue, 7 to 10 business days under calm conditions. During panic, when everyone is trying to flee at once, these systems can freeze entirely. Not because your bank is collapsing, but because modern finance was engineered to prevent exactly what that 1929 businessman did: escape. This is the quiet truth no one discusses. The difference between 1929 and 2026 isn't just another crash. It's that when the next crash hits, you won't be able to do what earlier generations could do without hesitation. Grab your money and run. Your wealth now sits inside digital cages, time locks, penalty gates, and legal barriers that seal shut the moment the crowd moves. Every mechanism that traps your savings was built deliberately, not to protect you, but to protect the system from you. So you can't make the rational choice to save yourself when disaster approaches. The crash of 1929 was devastating because of speculation, leverage, and debt. The crash of 2026 will be catastrophic for a different reason. Digital cages that stop escape even for those who see danger coming. Let me take you back and show you how we got here, why the traps today are tighter than ever, and why 2026 makes 1929 look like a rehearsal. The crash of 1929 destroyed millions of lives, but it still offered one lifeline the modern world has quietly taken away: immediate access to your own money standing. This difference is crucial. In 1929, your savings account was simple. You walked into your bank, handed over your passbook, a small ledger of handwritten entries, and asked for your balance. The teller reached into the drawer and counted out cash. Same-day withdrawals weren't unusual. They were standard. No processing delays, no approval layers, no suspicious activity flags. If you wanted your money, you walked out with it within the hour. Stock ownership was just as straightforward. When you bought shares, you received physical stock certificates, ornate sheets of paper bearing your name and your exact share count. These weren't digital entries on a server. They were property you could hold. To sell, you could hand the certificate directly to a buyer or sell through a broker with settlement in 3 days, not 3 weeks, and never subject to trading halts. 3 days every time. This meant that investors who sensed trouble in September 1929 had real options. They could sell their positions, withdraw their savings, and convert everything to cash or gold. Many did. The system didn't trap them. It simply waited for their decision. The tragedy was that most people didn't see the danger until it was too late. When the crash struck on October 24th, 1929, those already in cash and gold survived. Those who hesitated, who trusted reassurances, who waited just one more day, were ruined. Their destruction came not from a locked system, but from their own choices. Not from the system physically preventing action. Banks in 1929 didn't freeze accounts ahead of time. They didn't impose withdrawal limits or require supervisor approval for large cash requests. They collapsed simply because too many people withdrew too much, too quickly. That's what a bank failure is. Brutal, direct, and undeniable. But what we have today is entirely different. Even margin calls back then were straightforward. You borrowed money to buy stocks, 10% down, 90% borrowed. When prices fell, brokers demanded more cash. If you couldn't provide it, they sold your shares immediately to make themselves whole. Harsh, instant, and transparent. You always knew where you stood. Compare that to today's retirement accounts, where money is locked behind penalty walls until age 59 and a half. Compare it to modern banks that can freeze accounts for suspicious activity if you withdraw too much. Too fast. Compare it to investment funds that can legally suspend redemptions during periods of market stress. The 1929 generation endured a devastating crash, but they weren't living inside a system designed to trap them. We are. After 1929, regulators didn't just try to prevent another collapse. They constructed something far more ambitious, a financial framework that prevents people from escaping during a crisis. Every major reform from 1933 to 2010 had the same objective: eliminate ordinary people's ability to trigger bank runs or market panics by withdrawing their own money. The first cage was the 401, created in 1978 and marketed as a tax advantage. But look at what it became. Over $7 trillion in American retirement savings locked behind penalty walls. You contribute your entire working life, but cannot touch it without facing combined taxes and penalties that typically eat 35% to 45% of your withdrawal. And penalties are only the first lock. The second is time. When you request a 401k withdrawal, the money doesn't arrive instantly. Plan administrators process requests over 7 to 10 business days under normal conditions. During market stress, when everyone is trying to withdraw simultaneously, those timelines stretch indefinitely. Some providers can legally suspend withdrawals altogether for administrative review or valuation uncertainty. This happened in 2008. Fidelity, one of the largest 401k administrators in the country, suspended certain withdrawal requests for weeks. Participants logged in only to find temporarily unavailable messages. Their money still showed on the screen, but they had no access to it, not because the funds were gone, but because the system includes gates designed to close during volatility. And then there's modern banking, which has quietly restricted cash access for years. Try withdrawing $10,000 or more in cash. Federal law requires banks to file a currency transaction report with FinCEN. Banks also have the discretion to delay your withdrawal for a suspicious activity review if they decide your request is unusual. Daily ATM limits typically cap at $500 to $1,000. Meaning even if you have $50,000 sitting in your checking account, accessing it physically would require 50 to 100 separate transactions spread across weeks or even months. The crisis would be long over before you could pull out your own cash. But the most dangerous trap of all lies inside investment accounts, mutual funds, ETFs, and brokerage holdings. Most investors don't realize their ability to sell relies entirely on market makers providing liquidity. And that liquidity disappears at the very moment you need it most. In March 2020, more than 200 exchange-traded funds traded at steep 10% to 20 discounts to the value of their underlying assets. Your $100,000 ETF was suddenly worth only $80,000 to $90,000. Not because the assets crashed that far, but because the market structure itself broke down. Mutual funds contain even more explicit traps. SEC Rule 22E4 allows funds to keep up to 15% of their holdings in illiquid assets. When those thresholds are exceeded, funds can legally suspend redemptions altogether. This isn't theory. The Woodford Equity Income Fund in the UK froze redemptions in June 2019, trapping £3.7 billion for more than 3 years. When redemptions finally resumed, investors walked away with roughly 70 cents on the dollar. Real estate investment trusts did the same thing during 2008 and 2009, suspending withdrawals for an average of 18 months. Private equity funds lock money up for 7 years with 0 early exit options. Every one of these restrictions was marketed as protecting investors or stabilizing markets. But the effect is the same. Your money is no longer available on demand. It's available only on the system's terms that can change instantly during a crisis. The 1929 investor could grab cash and leave. The 2026 investor will click Withdraw, watch a loading screen, and discover the request is pending, subject to delays or outright suspension if conditions deteriorate. And by the time access is finally granted, the wealth they were trying to save will have already evaporated. These mechanisms are already in place, embedded in every retirement plan, every bank account, every brokerage platform, every fund. They're simply waiting for the moment when everyone tries to use the exit at the same time. The traps have always existed, but 2026 is when they become catastrophic, not because the rules change, but because of what lies underneath. Unprecedented debt, algorithmic trading, and a Federal Reserve that has already used up most of its ammunition. Start with leverage. In 1929, investors bought stocks with 10% down and 90% borrowed on margin. That 1 leverage turned a 10% decline into a total wipeout. Regulators raised margin requirements to 50% after the crash, believing they had solved the problem. But today's leverage doesn't live in visible margin accounts. It lives in derivatives, collateralized loan obligations, and private equity structures, creating hidden leverage of 1 to 50, 1. When that unwinds, it won't take months like it did in 1929. It will happen in hours, as computers follow pre-programmed selling strategies. Unlike 1929, when selling required humans shouting orders on a trading floor, today nearly 70% of volume comes from algorithms executing millions of trades per second. These algorithms dump assets when volatility spikes, when momentum breaks support levels, when correlations signal danger. One algorithm's selling triggers another, creating cascades that move faster than any human can respond to. We saw a preview of this in March 2020. The S&P 500 dropped 34% in just 23 days, the fastest bear market in history. Trading was halted multiple times using circuit breakers designed to give markets a moment to breathe. But those halts didn't stop the selling. They compressed it into smaller windows, creating even more violent moves the moment trading resumed. Now imagine that with every trap I've described fully activated. You watch your 401 plunge 30% in just 2 weeks. Panicked but desperate, you submit a withdrawal request, willing to sacrifice a brutal 40% penalty just to get something out. But the request doesn't execute. It just sits in processing, while the market sinks another 20%. By the time it's finally approved, you've already lost 50%, and only then do you pay 40% of what remains in penalties. Your $200,000 retirement account shrinks to barely $60,000, and that's assuming the withdrawal is even approved. During peak crisis, administrators can invoke extraordinary circumstances, legal clauses that suspend all distributions. You're forced to watch your balance deteriorate, unable to act, trapped inside systems designed to function exactly this way. Banking is just as fragile. In 1929, banks failed because they couldn't recover cash fast enough when depositors demanded it. Today, banks hold more reserves and operate under tougher rules. But reserves mean nothing if the payment systems that move money freeze. Modern banking runs entirely on digital infrastructure. Fedwire for large transfers, ACH for routine payments, SWIFT for international flows. Each system has quotas and bottlenecks that get overwhelmed during stress. In September 2019, during a period of economic calm, with no crisis at all, the overnight repo market shot from 2% to 10% in a single day. The Federal Reserve had to inject $75 billion just to prevent the system from seizing up. And that was during stability. When real panic hits, these systems don't bend. They stop. Silicon Valley Bank collapsed in March 2023 in just 36 hours. Customers learned on Thursday afternoon that the bank was in trouble. By Friday evening, regulators had taken it over. Depositors with more than $250,000 had no access to their funds until the following Tuesday, when the FDIC created a bridge bank, 4 full days without money. For companies with payroll due and invoices to pay, that 4-day freeze was existential. Now, multiply that scenario across the entire system during a real crash. Not one regional bank, but dozens. Not billions in deposits at risk, but trillions. The mechanics simply don't scale. The FDIC holds roughly $125 billion to insure $10.5 trillion in deposits. The math collapses the moment even 5% of banks fail at once. And this is why 2026 is said to be far worse than 1929. The speed is faster because of algorithms. The leverage underneath is greater because of derivatives. The tools to fight a collapse are already exhausted. Interest rates sit at 5%, leaving almost no room to cut. The Federal Reserve's balance sheet is bloated from years of quantitative easing. Government debt sits at $35 trillion, removing the possibility of massive stimulus. And unlike in 1929, when people could still protect themselves by withdrawing cash or buying gold, the modern system has sealed those exits. Digital gates, penalty walls, processing delays, legal restrictions, every barrier designed specifically to trap your money at the moment you need it most. The 1929 crash took 4 years to reach the bottom because people could pull out, wait, and survive. The 2026 crash will be faster and deeper precisely because they can't. The crash hasn't arrived yet. But if you know where to look, early movement is already visible. Not in headlines, but in the quiet actions of those with the most to lose. Corporate insiders, sovereign wealth funds, institutional players with access to information the public never sees. In the fourth quarter of 2024, corporate executives sold stock in their own companies at levels not seen since 2021. Insider selling at $16.2 billion in just 3 months. Executives were exercising options and dumping shares at 4 times the usual rate. These aren't retail investors panicking. These are CEOs, CFOs, and board members. People who see internal numbers before earnings are released, who sit in strategy meetings where real problems are discussed. When insiders sell, they're not preparing for a mild 10% correction. They're getting liquid before something much larger breaks. Sovereign wealth funds are making the same moves. Data from the third and fourth quarters of 2024 show major reallocations away from U.S. equities and into gold, commodities, and short-duration bonds. Norway's government pension fund cut its equity exposure by 18% in 2024. Abu Dhabi's investment authority increased gold holdings to levels not seen. These aren't institutions that panic. They manage trillions across decades, prioritizing long-term stability over short-term gains. When they shift this defensively, it's because their models show risks strong enough to justify sacrificing upside just to protect capital. Then there's the treasury market, the $27 trillion backbone of global finance. In October 2024, liquidity began deteriorating in ways that mirrored pre-crisis conditions. Bid-ask spreads widened sharply. Large orders that once moved prices by only a few basis points were suddenly creating 15 to 20 basis point swings. This is the kind of illiquidity that precedes breakdowns. It means there aren't enough market makers willing to take the other side of trades. Investors are growing uneasy about holding even treasuries, the asset class historically considered the safest in the world. And while this unfolds, the media and Wall Street cheerleaders keep repeating the same comforting lines used in 1929. The economy is strong, earnings are solid, innovation justifies valuations. This time is different. It's never different. The Shiller PE ratio sits at 39 as of October 2025. It was 32 before the crash of 1929, and 32 before Today it's 23% higher than both those peaks. Yet somehow investors are told that artificial intelligence justifies valuations. Previous generations would have called insane. The yield curve has been inverted since July 2022, more than 3 years. Every recession in the past 70 years was preceded by an inversion, typically 12 to 18 months before the downturn. We are now 39 months into inversion, well beyond historical norms. What makes this moment uniquely dangerous is that all these warning signs are flashing, while the trap architecture I described is fully operational. In 1929, people had escape routes, even if most didn't use them. Today, those who understand what's coming, insiders, sovereign funds, institutions, are quietly repositioning.
Stay the course.
Meanwhile, the ordinary investor with a 401k and a savings account has no idea. They're being told to stay the course, keep contributing, ignore the noise. In truth, they're being positioned as exit liquidity, the last buyers before the trap snaps shut. History doesn't repeat perfectly, but it follows patterns that anyone can see if they're willing to look. The crash of 1929 wasn't random chaos. It was the mathematical result of excessive debt, extreme speculation, and a collective belief that old rules no longer applied. The crash of 2026 will follow the same pattern, with one crucial difference. When it hits, you won't be able to do what the survivors of 1929 did. You won't walk into your bank and withdraw your life savings the same afternoon. You won't sell investments without crushing penalties, long processing delays, or outright suspensions. You won't have the freedom to protect yourself because the system was built specifically to prevent mass exit. Remember that businessman in September 1929? He survived because he acted before the crowd realized that danger was real. He didn't need permission. He didn't wait for processing periods or pay penalty fees. He didn't hope the system wouldn't freeze. He recognized the risk, took his money, and got to safety. You no longer have that option. The exits that saved him have been sealed. But you still have choices. You can acknowledge the traps and operate within the constraints. You can reduce exposure to penalty-locked accounts by redirecting new contributions toward accessible savings, even if it costs tax advantages. You can build cash reserves outside their retirement system, accepting the tax burden now instead of risking a total loss later. You can watch what insiders are doing with their own money. When smart money is selling while telling you to buy, it's worth asking why. Or you can do what most people will do. Trust the system, believe their assurances, keep contributing to accounts you can't access during a crisis, and convince yourself that this time really is different. That algorithms and AI have somehow eliminated the business cycle. That central banks can prevent real pain. That markets will always go up if you just hold long enough. Every generation believes it has evolved beyond the lessons of history. The generation of the 1920s thought industrial technology had created permanent prosperity. The generation of the 1990s believed the internet had erased old economic realities. The generation of the 2020s thinks artificial intelligence has conquered risk. They're all the same belief, just wearing different clothes. The people who survive crashes aren't the smartest or the best connected. They're the ones who recognize the pattern before anyone else. The ones who are willing to look paranoid while others celebrate. The ones who understand that protecting capital matters more than chasing the last 20% of an overinflated bubble. The traps are set. The warning signs are flashing brighter than they have in decades. Insiders are quietly heading for the exits while telling you on television to stay invested. The question isn't whether the crash is coming. The question is whether you'll be trying to escape through exits that no longer exist, trapped behind digital gates while your wealth evaporates, or whether you'll have positioned yourself outside the cage before it locks. Your grandfather in 1929 could grab his money and run. You can't. Not anymore. But you can still prepare for what's coming if you act before the crowd realizes the danger is real. Because once everyone tries to leave at the same time, the gates close, the systems freeze, and the wealth you thought you had becomes nothing more than a number on a screen that shrinks by the hour while you watch. Helpless and unable to act, the choice is yours. The timeline is closing.